Good morning, good afternoon, or good evening, whichever is appropriate for you. This is the fifth episode of Keeping Ahead in Uncertain Times from the Melbourne Business Network. This is episode 5 on the way home, and we sincerely hope we are on the home straight. And my name is Brian Jones. I'm from Ahead for Business, and we are members of the Melbourne Business Network. Just a quick overview of what I'm going to talk about today. I'm going to look at JobKeeper Relief Extension 1, which goes right the way through to the 3rd of January. There is an Extension 2 after that. What is included in the JobKeeper minimum? 220 federal budget measures, which include the JobMaker hiring credit. So now we have JobKeeper, JobSeeker, and JobMaker. Various other 220 federal budget initiatives, and quite a bit of detail on Victorian grants available. Now for the disclaimer. I'm not going to read this all through, but it is very important that we do disclaim on this presentation, because everybody's individual circumstances are different, and you should consult your trusted financial advisor or a government department. Moving on to JobKeeper Extension 1. JobKeeper Relief Extension 1 is very similar to the first JobKeeper Relief. However, the main turnover test now relates to a comparison of a quarter in 2020 with a quarter in 2019, and that quarter for extension period 1 is July to September 2020 versus the same period in 2019. In other words, they are using BAS quarters. If turnover has fallen by 30% or more with this year-on-year comparison, a business or business participant is eligible for JobKeeper relief. This test relates to GST inclusive turnover. That's because effectively it's easier for the tax office to assimilate that information. If the GST basis is accruals in 2020, it must be compared to an accruals basis in 2019. You can't pick and choose between which basis might get you over the line for the 30%. You have to compare apples with apples. If the GST basis is a cash basis, which relates to businesses with under 2 million turnover, the comparison must be on a cash basis in both years. Most businesses under 2 million are on a cash basis, but you can actually opt for an accruals basis if you wish to. Now, a little bit more on extension 1. We've seen the turnover test is a prime test, but there are other tests available should they be relevant when an accurate comparison cannot be made. And I think at the last count there are 8 different types of other tests available. This is a bit more involved than the straight turnover test. JobKeeper Extension Relief runs for 7 fortnights through to the 3rd of January 2021, and it comes in 2 stages. There's a full-time rate of $1,200 per fortnight, or a part-time rate at $750 per fortnight. The part-time rate relates to any employees working less than 20 hours a week on average in a 4-week period in what's called the relevant period. Now, the relevant period is either the 4 weeks before the 1st of March 2020, when the first JobKeeper commenced and people were first benchmarked as employees, or the 4 weeks before the 1st of July 2020. Now, the reason for the second date is because in the intervening period between initial restrictions and then easing of restrictions and then back to restrictions, it's particularly in Victoria, that certain people could be employed in that window between the 2 restriction periods. So there have been cases of employees being employed before the 1st of July. You can actually choose which period you wish to be benchmarked to. So what is to be included in the minimum $1,200 or $750 that must be paid to employees in any one fortnight? This is a problem for many payroll administrators, I would imagine. But included for employees are gross salary, which is obvious, allowances, overtime, shift and penalties, bonuses and commissions, PAYG withholding amounts, because we're looking at gross wages, and amounts under salary sacrifice amounts. The types of things that are not included are things like parental leave payments, workers' compensation or work cover payments, reimbursement of expenses, directors' fees, lump sum payments such as termination payments, exempt foreign income, and some fringe benefits provided to individuals which are not part of a salary sacrifice arrangement. Now, some other issues relating to JobKeeper relief. Firstly, assessable income. JobKeeper relief payments are assessable to income tax, and the reason for that is because it is a subsidy to employers to enable them to pay their employees. It's not a subsidy directly to employees, and effectively what that means is it is a substitute for the lost turnover, hence the importance of the 30% turnover test. With the new JobKeeper Extension 1, monthly declarations are still necessary of turnover. These must be submitted usually by MyGov to the ATO. The ATO will not take any action when they see these figures. They're purely for their statistics, so you will not be eliminated from JobKeeper Extension 1 once you've been enrolled. Also, activity statements, these must be up to date, otherwise you will not receive the JobKeeper payments. And special mention for business participants. These are a whole host of different types of participants. They're sole traders, beneficiaries of trading trusts, partners in a partnership, shareholders in the company. No minimum payment is required, unlike employees, for these in a fortnight. Because they are paid in many different ways. Some of them are only paid on an annual basis. But it is important that particularly sole traders do take note that they are eligible for JobKeeper relief, and that includes the Extension 1, and should check whether they do pass that 30% turnover test, July to September 2020 versus July to September 2019. And just a final point on eligibility, it is not necessary to be enrolled in previous JobKeeper. So just to get the Extension 1, you may not have claimed JobKeeper in the past, but you can enroll for JobKeeper Extension 1. This is because the problem created by the COVID-19 crisis is just continually rolling, and it has to be accepted that people may have been below the thresholds in the first period, but may not be below the thresholds in extension periods. And something that does crop up, casuals who were short-term were not eligible originally for JobKeeper relief. Short-term meant less than 12 months, but they may well have become long-term casual employees in the period since March. So it's worth looking at any casuals who may now be eligible because they're classed as long-term. Now I'm going to look at some federal budget relief that came out recently, and I've split this into two sections. One is what might be called direct measures, and one called indirect measures. And the prime direct measure is the new job maker hiring credit. So we've had job seeker, people looking for jobs. We have job keeper, that's to keep people in jobs, and now we have a job maker initiative. This is to incentivize employers in taking on additional young job seekers. So it's very much biased towards younger participants in the workforce. So from the 7th of October 2020, eligible employees can claim $200 a week for each additional eligible employee hired who is aged between 16 to 29 years old. This falls to $100 a week for each additional eligible employee who's aged 30 to 35 years old. So the scheme relates to anybody under 35 years of age. New jobs created until October 2021 will attract the credit for up to 12 months from the date the new position is created. So what I understand by this is that at any time in the next 12 months or so, if you create a job that is eligible, you will be able to get this payment for a year. So you could create the job in June 2021 and you will still get this this payment. It's claimed quarterly in arrears from the ATO from the 1st of February 2021. So like many other measures, these are not immediate. It's going to be February before people can actually make a claim for this relief. Quarterly reporting is required, and it's capped at 10,400 for each additional position created. And perhaps not surprisingly, the total credit that can be claimed by employer cannot exceed the amount of the increase in the payroll for the reporting period. This wouldn't make sense if that were the case. Now a bit more on job making hiring credit. An eligible employee, this is very widespread. It can be permanent, casual or fixed term basis for the employment, 16 to 29 or 30 to 35 years of age. Must work at least 20 hours per week, so that's the equivalent of the full-time category for JobKeeper, and that's on average, so it's 20 hours per week on average in a month effectively, or 4 weeks. And they must have received the job seeker payment, that's the employee, youth allowance or other parenting payment for at least 1 month within the 3 months before they were hired. They must be in their first year of employment with this employer. So this is not available to employers who've stood down employees and then brought them back in again. It's got to be a new relationship and must be reemployed for the period for which the employer is claiming, which I think is fairly obvious. Exclusions can exist, however, especially for employers already receiving wage subsidies under another program, and if there is any possibility this applies, you need to do further searching to see if the payment is applicable. Now moving on to the eligible employer. An eligible employer must have an ABN, that's standard for anybody who's actually trading. Be up to date with all tax lodgements, that's a standard rule throughout the whole relief system. Be registered for PAYG withholding. Must be reporting through the single touch payroll system, most small businesses are. And the claims must be in respect of eligible employees, which we've seen in the previous slide. But also must keep adequate records of paid hours worked by employees. That seems fairly obvious. And can also demonstrate a genuine increase in payroll. So that's an increase in the head count of employees or the dollar of actual payroll. And here's a piece of what seems to be anti-avoidance. New employers created after the 30th September 2020 are not eligible for the credit for the first employee. This seems to be to prevent artificial arrangements. And a critical thing to remember is that this is a separate type of relief. So a fall in turnover test does not apply to claims for job maker hiring credit. Now moving on to some fringe benefits tax changes. These are necessary because the retraining and reskilling costs were not exempt from FBT. So there's now an FBT exemption for retraining and reskilling for redundant or soon to be redundant workers. And the benefits that from this retraining and reskilling does not have to be related to their current employment. So somebody who is serving in hospitality might be retrained in web design, who knows, and that is perfectly permissible. So this is to encourage employers to assist redundant workers transition to new employment opportunities, and they can be any other kind of opportunities. It doesn't apply to retraining under a salary package arrangement, which is already in place, for example, or Commonwealth supported places at university. The government is also going to consult in relation to individuals claiming a deduction for themselves for the cost of retraining. So I think it's fair to say that some of these things are announced in the budget, but they're not necessarily complete. They're just statements of intention. Now, a couple of other things from the federal budget which may be of interest to some people. The first is connected to mental health and small business. There's been a lot of concern about mental health with months and months of restriction and lockdown. 7 million is being provided for COVID-19 support. 4.3 million of this is actually tailored support for small business owners, for example, expanding Beyond Blue's New Access program. And 2.2 million has been earmarked to expand a free accredited professional development program. On the insolvency side, it may surprise quite a lot of people that the insolvency industry has never been so quiet. Now, one of the reasons for this is that because of all the deferrals available, the ATO are not sending out statutory demands, for example, there's been far less insolvencies going through the system. But that will all change when we get to the 31st of December, when some of those deferrals finish, in actual fact. So these insolvency reforms are for small business to enable them to restructure debt, and this is for businesses with liabilities under 1 million, and simplify the liquidation progress, and also some measures to support the insolvency sector, which is not faring very well at the moment. The interesting thing is that a lot of this surrounds allowing small businesses to trade out of their problems. In the end, a proportion of those small businesses will have to fold, but I think the hope is that many of those businesses will actually come out and still continue. The temporary insolvency and bankruptcy protections introduced in March 2020, when we started all the COVID-19 measures, is due to expire on the 31st of December 2020. So one thing that would be expected is that the ATO will start issuing statutory demands, which they've held back on because of these measures right at the beginning of COVID-19. Now I'll move on to some indirect measures of the 2020 federal budget. And these are measures that go through the tax system. An important point, I think, overall is that many measures that are made through the tax system have a kind of time deferral on them, and some of these reliefs will not be available to most people before the 30th of June 2021, and that's quite important in terms of certainly in terms of cash flow effect. So some of the measures relate to things like tax rate changes. Now, tax rate changes take place fairly commonly in budgets, but these rate changes have been set for 2021 to 2024. And they concern thresholds. So the tax thresholds have been increased for three ranges. For example, the 19% tax rate extends currently up to 37,000. It will go up to 45,000. The next threshold, 32.5% tax, the threshold will be extended to the top level. It will be extended from 90,000 to 120,000, and then the 37% tax threshold remains the same at 180,000. 180,000 is when the top rate of tax at 45% clocks in. These exclude Medicare levy and, of course, any other levies. And we've certainly seen a temporary budget deficit levy, and I think we've seen a flood levy a few years ago. These temporary levies could always be added to these rates. In terms of low income offsets, now some of these things were planned already, but the low income tax offset with the mnemonic LITO is increasing from 445 up to 700. And will apply from the 1st of July 2020. It was meant to come in 2021, so that's just brought forward a year. But the actual benefit of that will not really be seen until tax returns are lodged at the 30th of June 2021. Another version of that is LAMITO, low and middle income tax offset, which continues to apply with a maximum at 1,080 between incomes of 48,000 and 90,000 in the 2021 year. Now, we can't predict what they might have done had COVID-19 not occurred, but there's obviously some bringing forward of some measures that were anticipated. Now some quick points on small business tax concessions. These are being expanded for medium-sized businesses. These are businesses with turnovers of 10 million to 50 million turnover, and there's something like 10 small business concessions which might apply, but they don't apply to every single taxpayer. There is now an immediate deduction for startup expenses and prepaid expenditure, and that's available from the 1st of July 2020. Again, that won't, the benefit of that won't really be seen until the 30th of June 2021. There is some exemption from FBT for eligible businesses, for example FBT on parking and work-related portable electronic devices, and that kicks in on the 1st of April 2021, which is the start of the fringe benefits tax year. There are various other measures which include, for eligible businesses, access to trading stock rules, the remission of PAYG on a GDP notional tax basis, which is a set basis at the beginning of the year, and the ability to settle excise duty monthly on eligible goods. Again, only applies to certain taxpayers. The ATO now only has a 2-year amendment period to amend tax returns. That used to be much longer. Now moving on to the immediate write-off on depreciable assets. This started off at 30,000 before COVID and was then extended to 150,000 up to the 31st of December 2020 for turnovers between 50 million and 500 million, and also included second-hand assets. Well, firstly, this period is being extended to the 30th of June 2021, but furthermore, the write-off is now uncapped for turnovers up to 5 billion, so that's a large number of taxpayers. But the difference is that with that uncapped amount, the assets must be new depreciable assets, or the cost of an improvement to an existing asset. In other words, second-hand assets are not available in that uncapped limit. Now here's something of interest. It's the carryback of tax losses for companies. It was originally a permanent tax initiative a few years ago and then was discarded. It is now a temporary issue, and it's available to companies with a turnover less than 5 billion, and they can carry back losses from 2020, 2021 or 2022 income years to offset against previous year's taxable profits made in or after 2019 income year. So it's got a limitation on how far back it can go. It's only the 2019 year maximum, and this provides a refundable tax offset in the year in which the loss is made. Now this is to really cover situations where, particularly with COVID-19, losses are made in say 2020, whereas perhaps substantial profits were made in 2019, and it seems unfair that somebody has paid tax in 2019 and okay, doesn't pay tax in 2020 but doesn't get the benefit of the loss against the major tax paid in 2019. It is something that a lot of people would suggest could be permanent, and maybe it's been brought in as a temporary measure. Watch this space, it might end up being a permanent measure after 2022. The two provisos, and these are fairly obvious really: the loss carried back cannot be greater than the early tax profits, otherwise there would be a tax offset which is greater than the tax that would have been paid on those profits anyway, and cannot create a franking account deficit. Now a few other things from the federal budget which I think will be of interest to some people at least. The first is the tax-free business support grants. And this is specifically to Victoria in actual fact. Victorian business support grants for small and medium-sized businesses, which were announced on the 13th of September 2020, are non-assessable, non-exempt income for tax purposes. So that's going to be a relief for people who are receiving those. And there is a proviso that this measure could be extended to other states and territories. And this is for all grants issued up to the 30th of June 2021. And a couple of other things which are probably nothing to do with COVID-19, but are of interest. There is now an exemption from capital gains on granny flat arrangements. So I have to assume this didn't exist before the budget. It exists, of course, for principal private residences, i.e. usually where you live. Superannuation reforms, this is quite important. Super will follow you around, that's an individual. Now there's an organisation in Homebush near the Olympic Stadium in Sydney whose sole job is to track down for the ATO lost super. And they are literally dealing in billions of dollars of lost super, which people have somehow left behind them as they move from job to job. Now moving on to something very specific to Victoria, and in some cases just Melbourne. This is the third round of the Business Support Fund from the Victorian Government, and eligible businesses will receive grants of 10,000, 15,000 and 20,000. These employing businesses must be in eligible sectors, and these are as listed in the list of eligible ANZSIC classes as available on the Business Victoria website. Now, the classes of businesses that are included here are the business sectors that have most been affected by the COVID-19 restrictions. So entertainment venues and hospitality is an obvious example of that. Applications for these grants will remain open until the 23rd of November 2020, but in actual fact the other proviso is that or until the funds are fully exhausted. So anybody who considers they may be eligible should get in quickly now, because those funds may not be available all the way through to the 23rd of November. Eligible businesses are businesses that have a payroll under 10 million. And the level of grant is based on the size of the payroll. So 10,000 is available to payrolls with a payroll less than 650,000. 15,000 is available where the payroll is between 650,000 and 3 million, and 20,000 is available where the payroll is between 3 million and 10 million. Another version of Victorian relief is called the Business Resilience Package, and 3 billion is available in cash grants, tax relief and cash flow support for those who have been most affected by COVID-19. If the third round of business support doesn't apply to your business, you might also review this facility, the Business Resilience Package, to see if it applies to you. For example, the Licensed Hospitality Venue Fund, grants are available up to 30,000. There is a Sole Trader Support Fund of 100 million and grants of 3,000 to what is estimated to be 30,000 eligible sole traders is available. So this could be anybody from hairdressers to, say, retail outlets. Alpine businesses, a lesser amount, but grants are available up to 20,000. Business chambers and trade groups, there's 3 million made available for those groups. There's also the Melbourne City Recovery Fund, which is 100 million, and this is a partnership between the City of Melbourne and the Victorian Government. In fact, I think it's 50 million each to enable Melbourne to reopen up to Christmas. Okay, a little bit more on the Melbourne City Recovery Fund. 30 million is being made available to SMEs to pay for equipment or convert spaces like rooftops and courtyards into hospitality zones. I think it's quite obvious what they're doing there. They're trying to encourage outdoor dining and hospitality. 30 million is also available to support COVID-safe events and cultural activities. So I imagine that means some of the festivals that exist in Melbourne, and 40 million is available for physical improvements to CBD streetscape, so that's footpaths, bollards and plant containers. Quite interesting. Also there's some special relief available, grants available for outdoor eating and entertainment throughout Victoria. 87.5 million is made available. 58 million relates to grants of 5,000 for hospitality businesses with payrolls of less than 3 million. And 29.5 million are grants up to 500,000 to metro and regional councils, and 250,000 to rural councils for new infrastructure and outdoor dining. So there's a heavy emphasis overall in all these initiatives on outdoor activities. Some more initiatives that might be of interest to particular people. There's a 20 million voucher system to assist sole traders and small businesses to build digital capability through off-the-shelf digital programs. So that is one for a lot of small businesses to take note of. 15.7 million is being made available to help Victorian exports get their products to market. 8.5 million is being provided to market and expand the program to promote small Victorian producers and encourage Victorians to support local businesses. So be prepared to see quite a bit of advertising in the near future. There's also some waivers and deferrals of tax and other levies that are available. For example, there's a deferral of payroll tax for people who above the payroll tax threshold for payrolls up to 10 million in the 2020-2021 financial year. There's a deferring of a pre-existing landfill levy. There's 25% of the congestion levy in the central area of Melbourne is being relieved. The outstanding balance is also being deferred for the current year. Liquor license fee waivers for 2021 is another thing that's put forward, and a waiver of vacant residential land tax in 2020. Now, I would hope you've got something out of those 20 or so slides, but there is more detail available that you should look at, particularly if you've got a special interest. First is the tax office site, which is www.ato.gov.au, the COVID-19 area. Another very detailed site is a federal treasury site, www.treasury.gov.au/coronavirus. Some aspects of state-related issues are on the State Revenue Office, which is www.sro.vic.gov.au. You will also find a lot of very useful information on the Business Victoria site, which is www.business.vic.gov.au, and also on the Melbourne City Council's site, which will tell you a lot of things that are non-financial as well as financial, and that is www.melbourne.vic.gov.au. And thank you for working your way through this presentation today.